Here's something most people never think about. Who actually controls the money in your pocket? Not the bills, not the cards, not the app you pay with. I mean the system that decides. How much money exists, who gets it first, and why new money is created in the first place. Because in a modern economy, money doesn't come from mining, or gold, or treasure chests. It comes from decision-making. And no institution shapes those decisions more than the Federal Reserve. But don't worry. This isn't a conspiracy video. This is a picture of how the system really works, why it was designed this way, and how it affects you every single day. Let's break it down. Most people imagine money as something physical, cash, coins, something printed. But in the US and in most of the world, money is created by keystrokes. Not illegally, not secretly, but as part of an economic engine that nearly every modern country uses. Banks create money when they make loans. Central banks create money when they buy assets. Governments create money indirectly through spending. It's not magic, it's a design. And once you understand the design, everything starts to make sense. Why prices rise, why debt grows, why interest rates matter. Why financial markets react instantly to policy decisions. And this brings us to the most misunderstood institution in modern history. The Federal Reserve, often called the Fed, isn't a typical government agency. But it's also not a private company. It's a hybrid system, built in 1913, designed to balance two goals: stability, independence. The idea was simple. Create an institution strong enough to handle crises, but separate enough that day-to-day politics couldn't control it. So the Fed has a board of governors, appointed by the US President and confirmed by the Senate. 12 regional reserve banks, with governance that involves private banks. And a policy-making group called the Federal Open Market Committee, FOMC. This structure is unusual, yes, but it was built deliberately to prevent the banking panics that kept collapsing the US economy in the 1800s and early 1900s. The Fed was created to stop chaos, not to start it. Here's the part that sounds like science fiction, but isn't. When the US government spends more than it earns, which is almost every year, it issues treasury bonds, promising to pay them back. The Fed can buy some of those bonds. And when it does, it simply credits the government's account. No gold moved, no vault opened, no citizen made a deposit. It's digital. Why does this system exist? Because economies need a flexible money supply. Inflation, interest rates, growth, all depend on the flow of money. If the supply were fixed, every crisis would turn into a collapse. So the Fed adds money when the economy slows and removes money when the economy overheats. It's not perfect, but it's predictable. And the entire global financial system depends on that predictability. Here's where things get interesting. When new money enters the economy, it doesn't appear in everyone's pocket at the same time. It flows through the banks, financial markets, government spending, business loans. This means people closest to money creation. Large institutions, lenders, asset holders feel the benefits earlier, and everyday consumers feel the effects later, usually through higher prices. This isn't a secret plan. It's a structural feature of how modern economies work. Understanding that structure helps explain why asset prices rise faster than wages, why people with investments benefit more over time, why saving cash becomes harder during inflationary periods. This is not about villains, it's about incentives, and incentives shape outcomes. This is the question everyone asks. If the government needs money, why doesn't it simply create it directly? Short answer: because separating money creation from political cycles protects the economy from short-term decisions. Imagine if every election year, a politician could create unlimited money. Good luck controlling inflation. The Fed's structure forces economic decisions to follow economic data, not political pressure. Again, not perfect. But historically, countries with independent central banks have fewer crises than those where politicians print money freely. Money creation isn't the problem. Distribution is. If new money flows into financial assets, first the people who own assets gain the most. If wages grow slower than prices, households fall behind. If interest payments on national debt grow too large, governments face difficult choices about taxes and spending. The real challenge is navigating a system that rewards capital more than income, and you can only navigate it if you understand it. Every financial choice you make, your salary, your rent, your savings, your mortgage, exists inside this structure. You're not powerless, but you are playing a game with rules. Rules most people don't know. Rules that shape wealth more than talent, education, or effort. Learning these rules isn't optional anymore. It's survival. If this helped you see the system differently, subscribe, because the debt report is just getting started. The next episodes will dive deeper into modern money, global debt, power structures, and the hidden logic behind the economy you live in. History has the answers. I'll show you where to look.